Welcome to the Deep Dive, your shortcut to getting up to speed, designed just for you. Today we're unpacking Snap-on Incorporated's second quarter results for 2025.
Yeah, management, led by CEO Nick Pinchuck and CFO Aloe Poliari, they definitely navigated what they called a turbulent environment.
Turbulent, yeah. But the message that really came through, I thought, was one of resilience and balance.
Absolutely. And you can see that in the top line numbers. Consolidated net sales came in just shy of $1.2 billion.
Okay, and how does that compare year over year?
Pretty much flat, actually. There was a slight organic sales dip, less than 1%, but that was largely canceled out by favorable foreign currency translation.
Got it. And what about the margins? I heard something about the gross margin being quite strong.
Yeah, that was pretty impressive. 50.5%.
Wow.
And only dropped by 10 basis points. That's, a tiny fraction of a percent.
Even with currency working against them.
Exactly. Which really does speak to those continuous improvement programs they're always talking about.
Mm-hmm. It shows they're actually delivering.
Definitely. Now, the earnings per share, the diluted EPS, that landed at $4.72.
Okay.
But there's a bit of context needed there. It faced some pretty significant headwinds compared to last year, about 25 cents per share, actually.
25 cents? What caused that?
Well, a couple things. Last year, they had a one-off legal benefit that wasn't repeated.
Ah, right.
Plus, higher pension costs this quarter and about a 6-cent hit from foreign exchange, too.
Okay, so headwinds, but management felt they finished the quarter strong.
Yeah, they said they exited the quarter stronger than they entered, which is, a positive signal.
So resilience despite turbulence. Let's dig into how they managed that. The automotive repair market seems key here.
Oh, for sure. That remained a favorable spot for them.
What's driving that? Still seeing rising miles driven, cars getting older.
Yeah, all of that. Miles driven up, vehicle age increasing, and technician wages are climbing too.
So the demand is there. And they mentioned technician uncertainty has kind of stabilized.
Seemed like it. Now, how the different parts of Snap-on navigated this, that's where it gets interesting. Each segment had its own story.
Right. Let's start with the commercial and industrial group, C&I. You mentioned they felt the turbulence first.
Yeah, they did. Especially at the start of the quarter, they have a lot of international business project-based stuff. Management talked about Liberation Day, which sounds like code for the shockwaves from new trade policies and that geopolitical uncertainty.
Okay, so projects got delayed.
Exactly. Their reported volume was down like 6.5% initially. Organically, sales dropped over 7%. Operating margin took a hit too.
Ouch. But did it improve?
It did. They said customers started to, quote, accommodate as the quarter went on. Things started moving up again. And their order book actually started growing by the end, suggesting, a recovery was taking shape.
That's encouraging. Any bright spots within C&I even during the tough start?
Yeah, definitely. Especially torque. That part of business had a particularly strong quarter. They even launched a new product, the CTM 550 cordless torque multiplier.
Okay, what's special about that?
Well, it's way lighter, 66% lighter, they said, and 20% smaller than the old one. Delivers precise torque for heavy-duty stuff, but replaces clunky impact guns and wrenches with, one safer tool.
So targeted innovation helping to offset macro issues.
Seems like it.
Yeah.
Which kind of leads us nicely into the tools group.
Right, tools group. How did they do? Organic sales were up slightly?
Yep, up 1.6% organically, some modest improvement in the U.S.
And what about the technicians? Are they still spending?
Well, yes and no. Financially stable, generally, but showing some caution on the big long-term buys, like sales of those really large tool storage boxes. Those were down.
Okay, so if they're hesitant on big capital items, how did the tools group adjust?
They pivoted. Focus more on items with a faster payback for the technician. Things that solve an immediate problem, basically.
Makes sense. Any examples?
Oh, yeah, they highlighted a few, like the FCA S102 radiator pick set. Just helps get hoses off easily in cramped engine bays. Or the FKC 72 stubby ratchet. It's their smallest 38-inch drive one, designed for super tight spots. Like, if your fingers fit, the ratchet fits.
I saw something about redesigned pliers, too.
You did? The 15-inch extra-long needle-nose pliers, they make them right in Milwaukee using cold forging. Gives them apparently 85% more gripping power. Great for grabbing drop bolts or whatever.
And these new tools sold well.
Extremely well. All three of those became million-dollar hit products really quickly. Shows they hit a nerve, addressed real needs.
That's impressive. A quick pivot paying off.
And they also introduced a more budget-friendly tool storage option, the KR 2422 Classic Roll Cab, which also saw good demand.
Okay, so C&I recovering, tools group pivoting smartly. What about repair systems and information, RS&I?
RS&I just keep rolling along. Another strong quarter, sales up 2.3% organically.
80 margin?
Margin improved again, up 60 basis points to 25.6%.
Wow.
And get this, that operating margin has gone up year over year in 12 of the last 13 quarters.
12 of 13. That's remarkable consistency. What's driving that? Software.
Software's a big part, yeah.
Yeah.
And those continuous improvement efforts, again, they seem really embedded there.
Any big product news from RS&I?
Absolutely. The launch of the Triton Intelligent Diagnostics platform, they seemed really excited about this one, called it Gangbusters.
Gangbusters, high praise. What's the innovation there?
It's got a wireless connection between the handheld unit and the car, so the tech can move around freely, but still gets, like, wired speed.
Okay, freedom of movement, that's useful.
Yeah, plus a 2-channel lab scope with zoom. Super important for catching those really quick, intermittent glitches you see in waveforms.
Ah, the ones that drive technicians crazy.
Exactly. And it's got an 8-hour battery, 4 times the Emery.
Yeah.
Just built for efficiency with complex, modern cars.
So who's buying these? Dealerships? Independent shops?
Well, they noted some hesitation from independent shops on bigger garage projects, maybe. But the OEM dealerships, the brand dealerships, they are actively upgrading. They have to, really, to keep up with new vehicle tech.
So that's providing a nice tailwind for RS&I.
Definitely.
Okay, so that covers the main operating groups. How did all this filter down to their financial services arm?
Right. Snap-on Credit. Revenue was up just a bit, but operating earnings dipped.
Why the dip?
Loan originations were down almost 5%. That mostly reflects fewer sales of those big-ticket discretionary items we talked about, like the tool storage.
Uh-huh.
But interestingly, the launch of that new Triton Diagnostics platform actually boosted originations somewhat. So that helped offset the decline a bit.
And credit quality, how's that looking?
Okay. The U.S. delinquency rate for extended credit, people over 60 days late, it was up a bit year over year, but actually down from the prior quarter.
So maybe stabilizing.
Potentially. Trailing 12-month net losses were around 3.46% of the portfolio. Management seemed comfortable with that level, calling it relatively balanced for the current climate.
All right. And cash, did they maintain a strong cash position?
Oh, yeah. Very strong. Over $1.4 billion in cash on hand.
Yeah.
Cash from operations was a little lower than last year, partly due to working capital needs and slightly lower earnings, but liquidity isn't an issue. They've got over $900 million available on credit lines, no commercial paper out, plenty of dry powder.
So what are they thinking about doing with all that capital? Acquisitions?
They're open to it, yeah. But very specific, strategic, coherent acquisitions that fit their model. They explicitly ruled out anything transformative right now, said the M&A market is cautious, needs careful vetting, especially with trade policies being what they are.
Which brings us back to their manufacturing strategy, doesn't it?
It really does. They kept hammering that point home. Their make where we sell approach.
36 factories, 15 in the U.S.
Right. That distributed network, that localized production, they see it as absolutely central to why their gross margins held up so well against currency and tariffs.
They basically said, we told you this model works in this environment, and look, it did.
Pretty much, yeah. That adaptability, that structure, it really seems to be a core strength for them right now.
Any guidance points we should touch on quickly?
Sure. They expect corporate costs around $27 million a quarter going forward. And there's an increased pension cost, about $6 million pre-tax per quarter, which hits EPS by about 9 cents each quarter for the rest of 25.
Okay.
CapEx estimated around $100 million for the year, and the full-year tax rate should be somewhere between 22 and 23%.
Got it. Oh, and the 53-week year thing?
Yeah. Fiscal 2025 has an extra week at the very end of Q4. Historically, though, they said it doesn't really move the needle much on full-year or Q4 results.
Okay, good to know. So recapping the whole quarter, Snap-on showed some real operational muscle, adapting in a tough spot.
Definitely. That strategy of making things close to where they sell them, especially with those 15 U.S. factories, looks like a smart hedge against trade volatility and tariffs, key to that resilient gross margin.
And we saw the tools group pivot effectively to those faster payback items technicians wanted.
Getting those million-dollar hit products like the pick set, the stubby ratchet, those pliers, that shows they're listening to the market.
Well, RS&I just keeps executing, right? Margin expansion driven by software, and that Triton launch sounding like a big win.
Yeah, a really strong performance there. And even C&I, after that initial jolt, showed signs of finding its footing, especially with specialty torque holding up.
Plus, they maintained that strong balance sheet, disciplined capital approach, keeping options open for smart acquisitions, but navigating carefully.
A cautious but resilient posture overall, it seems.
Okay. Now, let's shift gears to our this is not financial advice segment, purely for discussion, purely theoretical.
Right. Given everything we've just discussed, especially Snap-on's ability to handle trade turbulence with its distributed in-market manufacturing, an advantage they really leaned into on the call. Here's an outrageous but plausible idea for, say, an investment committee discussion.
We're dubbing it the tariff resilience pair trade. The idea is go long Snap-on, ticker SNA.
And simultaneously, go short a competitor, maybe a diversified industrial, maybe another tool company, but specifically one that relies heavily on complex, centralized global supply chains, especially manufacturing concentrated in, say, China or other potentially volatile regions.
So the rationale is basically betting directly on Snap-on's unique setup in this increasingly protectionist world.
Exactly. While other companies might be struggling with tariffs, supply chain headaches, geopolitical risk, Snap-on's make where we sell model could let them absorb costs better, keep products flowing.
And maybe even grab market share from competitors who are less nimble. Right.
Precisely. That initial stumble and recovery in their C&I segment, you could almost see it at a real-world stress test. It showed they can accommodate and bounce back, validating that production strategy.
So it's not just a bet on efficiency, it's a bet on a fundamentally different, maybe geographically de-risked supply chain model winning out in uncertain times.
It's definitely a bold take, banking on that structural advantage playing out.
Absolutely. And remember, everyone listening, this is purely for informational discussion. It is not financial advice.
Please, always do your own detailed research. Talk to a qualified financial professional before making any investment decision.
But we'd love to hear your thoughts. Maybe you have your own outrageous but plausible trade ideas based on Snap-on's quarter. Let us know. Thanks for tuning in to The Deep Dive.